There's a building in your town with no plumbing in most of it, no staff most of the day, no product on its shelves, because it has no shelves and no product. Nobody browses it, nobody reviews it on date night, and yet this building quietly runs some of the best margins in American real estate. The self-storage facility. There are more than 60,000 of them in the United States. More locations than McDonald's, Starbucks, and Subway combined. Together, they collect over $50 billion a year for keeping boxes in the dark. Roughly 1 in 9 American households pays for one of these units, every month, often for years. And here's the strangest part. The customers lock their own money inside, guard it with their own padlock, and thank you for the privilege. Today, we're opening the books on the self-storage business, what it costs to build or buy a facility, why the boring economics beat almost every glamorous business you can name, the Price-Creep Playbook the big operators would rather you not think about, and the honest math on what an owner actually makes. And at the end, like always, this business gets the stamp. Clever, risky, or money pit. So, is a storage facility a clever investment? Let's open the books. To understand why investors love this business, start with what it doesn't have. It doesn't have inventory. A restaurant buys food that rots. A store buys products that go out of season. A storage facility sells emptiness. The product is a concrete box of air and it never spoils, never ships, and never gets returned. It doesn't have labor. Not really. A facility with 500 units might employ one manager. Some of the newest ones employ nobody at all. Cameras, smart locks, a kiosk, and a phone number. Compare that to the 15 employees a restaurant needs to serve the same revenue. It barely has maintenance. No kitchens, no plumbing in the units, no elevators in the single-story ones. The most common repair is a door spring, and it doesn't have demanding customers. Think about what a customer actually does. They show up once, fill the unit, lock it, and mostly never come back. No foot traffic to impress. No experience to deliver. The ideal customer literally forgets about you, while the autopay keeps running. Now add the demand engine, which economists politely call life events, and operators call the 4Ds: downsizing, divorce, death, and dislocation. People rent storage when life changes, moving, inheriting, splitting up, deploying, which means demand doesn't follow the stock market. In good times, people buy more stuff and store it. In bad times, people downsize and store it. The 4Ds never take a year off. Boring completely. And that's precisely the point. In business, boring is a moat. Nobody dreams of owning a storage facility, which is exactly why the people who do often out-earn the people chasing restaurants and boutiques. So what does it cost to get in? Here you have two very different doors. Door 1, build. A modern single-story facility runs surprisingly cheap per square foot. But you need a lot of square feet and land that zoning boards will actually approve because no city council ever got excited about more storage. Between land, site work, buildings, gates, cameras, and software, a new 50,000 square foot facility typically lands somewhere between $4 and $8 million. More if it's the multi-story, climate-controlled kind rising near apartments in big cities. But building comes with the industry's hidden tax: lease-up. A new facility opens empty, 500 units, 0 tenants, and fills at maybe 15 to 25 units a month if the market cooperates. That's 2 to 4 years of mortgage payments before the building pays its own way. Underestimate lease-up, and a great facility becomes a slow-motion crisis. Door 2. And this is the one most first-time owners should study. Buy. About 7 out of 10 American facilities are still owned by independent operators, many of them the people who built them in the 80s and 90s. They're retiring. Their facilities often run below market rents, paper ledgers, no website, no revenue software, and they sell for $1 to $4 million in smaller markets. A tired facility on a good corner, bought right and modernized, is the classic storage fortune. Raise occupancy, raise rents to market, add online booking, and you've added a third to the income without pouring a yard of concrete. Either door, the pattern matches what we saw with the car wash. This is a real estate business wearing a service business's clothes. The dirt and the location do the heavy lifting. Now, how does the money actually flow? A storage facility is a grid of rentable boxes, from closet-sized 5x5s to garage-sized 10x30s. Average unit, average market, somewhere around $100 to $150 a month. Climate controlled? At a premium. Big city market? Sometimes double. Multiply it out, 500 units at an average of $130 is $65,000 a month at full occupancy, over $750,000 a year from one unmanned building. But the number that rules this business is occupancy. The big institutional operators run their portfolios at 91 to 93% full. The national average across all facilities sits in the low to mid-80s. That gap, 10 points of occupancy, is often the entire difference between a mediocre owner and a professional one. And it comes down to unglamorous things: answering the phone, showing up on Google, keeping the gate working. And the smart operators play the grid like a puzzle called unit mix. The 5x5 closets earn the most per square foot. Small units always do, but they attract short-term tenants. The 10x20s earn less per foot, but hold long-haul customers. The small business storing inventory, the contractor storing tools, the family storing a whole downsized house. Getting the mix right for your specific market, students here, businesses there, snowbirds somewhere else, is one of the few genuinely skilled decisions in the business, and it's decided mostly before the concrete is poured. Here's what makes storage nearly unkillable, though. The break-even point is absurdly low. Because operating costs are so light, a typical facility covers its bills at somewhere around 40 to 50% occupancy. A restaurant at half capacity is dying. A storage facility at half capacity is paying its mortgage. Everything above that line is margin. And at stabilized occupancy, facilities routinely keep 60% or more of revenue as net operating income. Those are margins that software companies brag about, generated by a metal building full of other people's furniture. But the real genius of this business isn't the occupancy math. It's the pricing playbook. And once you see it, you'll never unsee it. Step 1. The teaser. That $29 first month banner? It exists for one reason: to get your stuff inside the unit. Operators will rent below cost to win the move-in, because they know something about you that you don't know yet. Step 2. Inertia. 6 months later, the rate notice arrives. Your $90 unit is now $110. Do you move out? Think about what moving out means. Renting a truck, burning a Saturday, hauling everything you own across town to save $20 a month. Almost nobody does it. The industry's own behavior tells you the number. Operators raise existing customer rates aggressively, often 10, 15, 20%, because the data shows tenants overwhelmingly stay. Your stuff is the hostage, and the ransom goes up annually. Step 3. Never the same price twice. Modern operators run revenue management software borrowed from airlines. The website quotes different prices for the same unit size depending on the day, the demand, even the competitor across the street. Street rate down, existing customer rate up. The spread is the strategy. Is it ruthless? A little. Is it legal? Entirely. Is it effective? The average storage tenant stays over a year, many stay several, and every one of them is on an escalator that only goes up. Remember the gym membership effect from the car wash video? Storage runs the same play with higher stakes. The gym hopes you forget your membership. The storage facility knows you can't forget because everything you own is in there. Now, the other side of the ledger, because light costs don't mean no costs. Property taxes come first, and they're the biggest line for many owners. That good corner gets assessed like the valuable real estate it is. Then, insurance, rising in storm markets. Utilities are modest. Lighting, gates, cameras. Unless you run climate control, where the HVAC bill becomes a real number every summer. Payroll. One manager, maybe a part-timer. Call it $50,000 to $80,000 a year all in, or nearly zero if you go fully remote operated. But someone still has to sweep units, cut abandoned locks, and handle the auction process when tenants stop paying. Yes, the storage wars auctions are real, and they're not a profit center. They're a legal cleanup ritual for maybe 1 unit in 100 each year. Marketing used to be a sign by the road. Now it's a knife fight on Google. Because when a REIT-owned facility opens 2 miles away with a corporate website and a wonder first-month promotion, the mom and pop that doesn't show up online simply stops receiving new tenants. Aggregator sites take their cut. The phone still has to get answered. Then there's delinquency, the cost nobody budgets for emotionally. Some fraction of tenants simply stop paying every month, and unlike an apartment, you can't just change the locks and move on. Storage line laws prescribe a patient, state-specific ritual of notices, waiting periods, and public auction before you can empty a unit. It's not expensive. Call it a low single-digit percentage of revenue. But it's a steady administrative drumbeat, and mishandling the legal steps is one of the few ways a small operator gets into genuine trouble. And the sneakiest cost of all, supply. Storage is easy to build, which means your market can absorb a new competitor faster than you think. The industry built out at record pace in the early 20s, and in the overbuilt Sunbelt metros, street rates actually fell for a couple of years afterward while everyone digested the new space. When your moat is location and inertia, the one thing that hurts is a fresh building with teaser rates opening on the same commute. Which brings us to Wall Street, because if this business is so good, the big money noticed decades ago. Public storage, the orange one you've seen everywhere, started in 1972 with 2 founders and 1 building. Today, it's one of the largest real estate companies on Earth, with more than 3,000 facilities and a market value in the tens of billions. In 2023, Extra Space Storage merged with Life Storage in a deal valued around $12 billion, creating the biggest operator in the country. Storage isn't a cottage industry anymore, it's an institutional asset class, sitting in pension funds next to office towers and apartment blocks. But here's the number that should make your ears perk up. Even after 50 years of consolidation, roughly 70% of facilities are still owned by independents. Compare that to hotels or fast food, where the chains own the landscape. Storage is one of the last real estate categories where a private buyer can still purchase from a retiring founder at a fair price, modernize, and either hold for cash flow or sell up the chain to the REITs, who are permanently hungry for stabilized facilities in good locations. That's the roll-up pattern we saw with car washes, but with a friendlier twist for the small player. In car washes, private equity is your competition. In storage, the institutions are also your exit. They'd rather buy your stabilized facility than build one and suffer through lease-up. The path from one facility to a life-changing sale is well-trodden and well-financed. The warning label, same as always. The model is public knowledge now. Cap rates on quality facilities have compressed, seller expectations have risen, and the easy deals of 2015 are gone. The money today is made in the buying. In finding the undermanaged facility the internet hasn't repriced yet. Let's put honest numbers on it. The buy-and-modernize play, since that's the realistic first deal. Say you buy an older 500-unit facility in a secondary market for $3.5 million, about 70% occupied, rents 20% below market, run off a paper ledger by an owner who built it in 1994. Day one, the facility grosses about $550,000 a year. Operating costs, taxes, insurance, utilities, one manager, marketing, repairs, run around 35%, leaving roughly $360,000 in net operating income. Now the modernization, online booking, dynamic pricing, Google presence, auto pay, and 18 months of patiently walking rents to market as units turn over. Occupancy climbs to the high 80s. Average rent rises to market. Gross heads toward 680,000. NOI toward 440,000. The bank's share, on a 70% loan, debt service runs roughly $200,000 a year. Owner's take, starting around $150,000, growing toward $250,000 on maybe $1 million of your own cash invested. And the kicker, that $70,000 NOI improvement didn't just add income. At the cap rates institutions pay, it added roughly $1 million to the property's value. You were paid twice for the same work. That's the good scenario. The bad one, you buy in a market where 3 new facilities are in the pipeline, lease-up stalls, street rates sag, and your below-market seller knew exactly what was coming. Storage forgives many mistakes, but it does not forgive overpaying in an oversupplied market. The 4Ds guarantee demand exists. They don't guarantee it shows up at your gate. So, is a storage facility a clever investment? Time for the stamp. For the patient investor who buys an existing undermanaged facility in a market that isn't drowning in new supply, this is about as good as small-scale real estate gets. Low break-even, sticky customers on a rising price escalator, minimal labor, recession-resistant demand, and a permanent institutional buyer waiting at the exit. That stamp's clever, with less of an asterisk than the car wash earned, because you can enter for $1 million instead of 5, and the machine has fewer moving parts. Literally. The risky version exists too, building new into a supply wave, or overpaying for a stabilized facility at a price that assumes rents only go up. The building is simple. The market timing isn't. Final verdict, clever. The boring crown jewel of small business real estate. Because it isn't really a storage business. It's a real estate business where the tenants furnish their own units, guard them with their own locks, and apologize when they're late on rent. Think the stamp is wrong? Tell me in the comments. Make your case. If this opened your eyes, subscribe. One business every video, books wide open, verdict stamped. And next time, the most famous passive income business on the internet, the one every guru swears will pay your rent while you sleep. The internet is mostly wrong about it. Is a laundromat a clever investment?